Inflation is a hot topic. Since 2020, we've experienced higher levels of global inflation than we've experienced for over 4 decades. And we already know inflation will continue to be a hot topic going into Q4 and into 2025. While recent estimates show that inflation is cooling faster than expected, the rate of increase is a key factor for how we gauge economic health and investments. But does inflation affect crypto? And if it does, how? In this video, we'll be exploring theories on how inflation affects crypto and if inflation might just be beneficial. Most commonly misunderstood as just a rise in prices, inflation is actually the rate by which the price of goods and services increase. The distinction between rate and price is important because it focuses on the process of measuring the amount of money required to purchase goods and services, in addition to providing clues as to what might be causing inflation in the first place. So, what does cause inflation? The most common cause for inflation is an increase in money supply. If there's too much money chasing after the same goods and services, then prices go up. This can also apply to government spending. If a government spends more money on goods and services than it sells, the imbalance increases demand, which in turn drives up the prices. A perfect example of this is the inflation spike in 2022. In March 2020, the US government passed the CARES Act, which involved spending $2.2 trillion to curb the economic impact of the coronavirus, the largest rescue package in United States history. Then again, a year later, in March 2021, the government spent another $1.9 trillion, distributing $1,400 to every American and giving extra funds to state and local governments, in addition to expanding unemployment as a part of the American Rescue Plan. Therefore, as a result of the government spending more money, the Consumer Price Index, or CPI, increased to 8.5% in 2022, the largest annual increase since 1981. And there are, of course, other factors that contribute to inflation spikes at a global level, such as international conflicts, spikes in oil prices, and disruptions in global supply chain, among others. But why does inflation matter? Inflation is a devaluation of money. It literally diminishes the purchasing power of your money and therefore the value of your investments. For example, if you earn 5% from investments in stocks and bonds with a 3% inflation rate, you only actually earn 2%. So increasing inflation rates suggests that money invested today will decrease in value tomorrow. The higher the inflation rate, the less power your money has, impacting everything from housing to groceries. And yes, even cryptocurrencies. If you're invested or interested in cryptocurrency, inflation could be an opportunity and a challenge. Let's look at Bitcoin. Based on historical data, cryptocurrencies like Bitcoin have acted as hedges to inflation. This could be because Bitcoin has a finite supply of only 21 million coins. The scarcity means it's more protected or safeguarded against pressure of high inflation rates, because the quantity of Bitcoin will always be limited and known. As a result, the creation of new unmined Bitcoin is predictable. But not all cryptocurrency is built the same as Bitcoin. Let's consider stablecoins. Stablecoins, unlike Bitcoin, pegs their value to a more stable reference point, such as a commodity or an actual currency. This pegging makes a stablecoin even more predictable and less volatile, while also remaining free of any centralized financial model. That being said, stablecoin will have the same inflationary response profile as their underlying asset. But as a decentralized asset, stablecoins could provide a way to store value against the inflation of a local currency. For example, in 2022, the US inflation rate hit a 39-year high of 7%. That same year, Turkey hit an inflation rate of nearly 36%, and Argentina reached a staggering inflation rate of 54.8%. These spikes in inflation are due obviously to the unprecedented amount of money governments were printing in response to the global pandemic and other factors that threaten their economic stability. The surplus of money made for the same finite amount of goods and services inevitably devalued their respective currencies. In response, people seek capital appreciation of their money through securities, real estate, and other assets that lock their money in for a period of time but lack liquidity. Enter stablecoins. In theory, stablecoins present a worthy investment opportunity if you want to secure your money's value against inflation while still maintaining liquidity. For example, let's say an investor or a group of investors in Argentina wanted to secure value against a 54.8% inflation rate. They could retain the value of their savings with a stablecoin like USDC, which is attached to the US dollar, and secure the value of their investment and maintain liquidity. Granted, this is a hypothetical, but the model opens up for interesting possibility for DeFi investments and a true global economy. Looking ahead to 2025, many economic experts anticipate that the inflation rates will gradually stabilize as central banks adjust monetary policies. However, if the current level of volatility in traditional markets continues, investors may seek refuge from inflation risks in decentralized assets or cryptocurrencies. While the future might be uncertain, one thing is, cryptocurrency has a significant potential towards creating a more accessible, transparent global economy. With concerns about rising inflation and increasing instability in traditional finance, the adoption of decentralized finance as a possible hedge and cross-border payment solution could skyrocket. To sum it up, inflation is a challenge for crypto, but it's also a unique opportunity ripe with possibilities as we learn to navigate shifts and changes in our modern economies. Stay informed and keep your options open. So, what do you think about inflation? What are your predictions? Let's keep this conversation going in the comments below.